This is Market Moves.
Today is independent investment expert Roger Montgomery. From some people today, some analysts who suggested in terms of stock picking at the moment, it's a little bit difficult because when you're looking at asset values, you know, sometimes we can see them a little bit inflated, a little bit underpriced. You'd assume that would mean it was a good stock price, but is that an issue at all, trying to find that intrinsic value?
No, I'm able to find I talk about it on my blog quite a lot. You know, I've got the intrinsic values of every listed company going back a decade and going forward 3, 4, 5 years. So based on expectations, of course. So I don't think it's that difficult if you know what you're looking for. It's just that once you know what you're looking for, there aren't many companies that tick all the boxes, and so you really do have to be patient for my particular brand of value investing.
We saw at today, at least, all the sectors were up, but in terms of looking longer term and so forth, are there any particular sectors that you are more in favour of, where you do find more intrinsic value? At
the moment, I noticed that there's a couple of it's interesting. It's the servicing businesses that there seems to be some value. So IT service businesses, the sort of businesses that service large company IT departments or service them, there seems to be some value there. The companies that service consumers, retailers, there seems to be some value there. And the companies that are servicing the resource sector, so that the pick and shovel suppliers, there seems to be a little bit of value there as well. That could all change tomorrow. You know, if we get a big a drop in the stock market, suddenly there could be a whole bunch of things that are cheap. All the banks appear to be trading at about their intrinsic value at the moment. I suspect the intrinsic value for the ANZ is about to jump. I've got to run through the numbers tonight, as I've been interstate today, but all of the banks, for example, I've got a steady increase in their intrinsic value over the next couple of years, and they're trading on or about fair value at the moment.
Okay, Roger, a fair bit in those two stories. I think maybe kicking off...
Interesting, isn't it? I mean, when a guy getting paid millions and millions of dollars a year and runs a bank that makes billions of dollars a year says, I don't know what all the fuss is about, it's not broken. Well, of course it's not broken for you, mate, you know. So, look, the reality is, you know, it's a bit of a red herring to say competition's fine because look at the margin over mortgage rates. They've come down. Well, from a community perspective, yes, that's true, but your profits keep going up. Now, that's a massive pool of money that's being drawn out of the economy. So they talk about, you know, having a strong banking system and it's good for the economy. Yes, that's true, but when you're sucking $5 billion out of the economy, you know, that's a cost to the economy. Let's not make mistakes about that. But on the flip side, if you have too much competition, as we've seen in Europe and the United States, then you have an unstable or you have instability in the banking system, and that's not good for anyone. And that can ultimately be very expensive. So it's a fine line that needs to be walked. Arguably, the notion that banks should be able to raise interest rates independently of the RBA, you know, fundamentally that's their right, but you can see from their profits there's absolutely no need to. So, you know, it's there for everybody to see.
What about the argument that we get from the banks about wholesale funding costs, regardless, I suppose, what the RBA is saying last few months, those haven't changed. They say, look, they are still well above pre-GFC levels, but are we ever going to get back to those levels?
But who cares? They just made a record profit, you know, just announced this enormous profit. It doesn't really matter, does it? No. You know, it's kind of just a moot point, isn't it? I mean, they're making money somewhere, and it is a cost to the economy when they take $5 billion out of the economy. It's a massive impost.
Heated debate with Roger Montgomery with us for this half hour. Telstra, as a stock, what do you think?
I think it's an almost impossible business to work out. Because I say that not because it's difficult to understand the business. It's relatively easy to understand this business. Its intrinsic value hasn't gone up for 10 years. Its intrinsic value is about $2.30. So it's still expensive compared to its value. Because it's so widely held, because it's such a big company, it's taken a long time for the price to reflect that value. Benjamin Graham once said, in the long run, the market's a weighing machine. In the short run, it's a popularity contest. We saw it very popular when it listed or shortly thereafter. It's taken a long time for the weight to get right. And now the market's correctly weighing this business. You've had massive growth in mobile phone subscriptions, massive growth in uptake in penetration of the internet in the home. Telstra's involved in all those businesses. Pay TV, Telstra's involved in that, or subscription-based television, as you like to call it. And yet there's been no growth in profits over the last decade. So with all that growth, profits haven't grown, so something dramatic needs to be done. David Thodey is doing that. It's really a cultural change that's needed in this business. It's the Titanic in terms of trying to turn it around, and maybe he can pull it off, and this is one step. It's sad for the people who are losing their jobs, of course, but it's what the business actually needs to improve its intrinsic value, because it's going nowhere at the moment.
We're going to have a bit of a look at a small cap stars. Roger, sometimes I suppose a bit of a market overlooked sometimes by investors, get dazzled by the big stocks.
Sure.
What small caps do you like at the moment?
Well, as you know, I like businesses that I regard as my A1 companies in terms of quality and performance, and so that's the first thing. You want to buy great quality businesses when they're very, very cheap or at a discount to their intrinsic value. There are fewer companies that fit the bill today than, say, 2 or 3 months ago. As you know, we've had a rally that coincides with quite a strong recovery in the market. But the two that I like, the first one is a company called Matrix Composite and Engineering. Its code is MCE. Now, I have to disclose that I actually own this stock, so if everyone rushes out and buys it, well, they're helping me more than themselves, so be mindful of that. But what I like about this business is it has little or no debt, very high rate of return on equity. It's an A1 business in terms of my quality and performance scores. I think its prospects are very, very bright, and the reason I say that is it manufactures, it's one of 4 companies in the world that manufactures buoyancy devices basically for deep sea oil rigs. So the pipes that they lay down, the transfer mechanism, there's a whole bunch of tools that they put under the water, and they need certain buoyancy devices in order for them to be suspended underwater. It's quite specific technology that they've got. The company only listed late last calendar year, so a lot of people think, oh, it's a new business, Roger, how do you work it out? Well, it's actually been in business since 1982, so it's been around a long time. They've perfected their technology, and I think their prospects are very bright, because I do believe that the oil price will go up again, and if it does, it becomes more economic. Deep sea exploration becomes more economic as the price goes up. They've got their revenue is underwritten with their forward order book, and I think for the next couple of years it looks very solid.
Okay, fantastic. It's a good tip from Roger there. Now, Roger,
I'd agree with the toll recommendation there. Underperformed definitely. I have an intrinsic value of $4.20. It's trading at closer to $6.20. So it's significantly over its intrinsic value, and it's a relatively mediocre performer in terms of economic performance.
What do you think then pushes the share price, the value above the intrinsic value? Is it sentiment that is sort of distorts?
Yeah, as I mentioned earlier, in the short run, the stock market's a popularity contest, and people jump on whatever the fad is at the time. And in Australia, we love a punt. So there's a lot of that. There's a lot of that in the stock market. Once an investor stops thinking about the business and starts betting on up or down, which is what many investors do, well, it's no different to going to a casino and betting on black or red. It's exactly the same. And the results ultimately will be the same. So I prefer to actually put that aside and say, well, I'm not going to participate in that. And some people will have windfall gains from doing it. But I say to myself, well, I'm just going to look for good businesses, buy them when they're cheap. And if there's nothing cheap at the moment, well, I'll come on the show and talk with you. And
look, just quickly, because we're almost out of time, Paul Little announcing he will step down. Does that sort of a change impact your value on a stock?
I actually believe that the business boat that you get into is more important than who's rowing the boat. There are some businesses where you could have an Olympic rower and it just doesn't matter. There's a big hole in the side of it and it's going to sink.
Yeah.
Toll is not that. It's not going to sink. But I really think the boat is more important than the rower.
All right. Roger Montgomery, look, always great to get your thoughts. Really appreciate you coming in this evening.
Thanks again.